As we wait for people to kind of enter slowly, I'm just going to take a slow start and say welcome, good morning to everyone joining us today at our next Angel Investor Insight series. Today, I've got a guest speaker coming in from Singapore, Mr. Phey Teck from Angel Central. He's one of the co-founders. I think if you followed the series, we had another session with his other co-founder too. So this is basically great to kind of get his viewpoints on how he angel invests within the scene too. But before we go any further, as we wait for people, just a brief background on who we are. So my name is Bikesh, founding partner of Leet Capital. Leet Capital is one of the 10 licensed ECF operators here in Malaysia, governed by the Securities Commission of Malaysia. We're part of a bigger collective. Our ecosystem is called Leet, 1337, if you heard of it, where we do angel investments, VC placements, syndications, and now new to our particular portfolio would be equity crowdfunding. So what is equity crowdfunding? Basically, it's a way that you could officially allow a company to raise money from the public, especially when you say public being retail investors, the mom, the pops, the people off the street itself. You can't do that officially in this particular country without a license, and we're one of the 10 operators. So what that basically means is it's a nice, easy way to democratize access to fundraising for startups and growth-based companies itself. Why do we need such a thing? We found that there's a lot of amazing companies we have in Malaysia, especially the SMEs. They are growing, startups, they are looking for capital. And maybe access to VCs are not always readily available. And some VCs kind of look at deals very differently from another person. So by you having an access to a platform that gives you a broader sense of people who could write you a check, gives you a better fighting chance to see eye to eye with someone who prefers your business model compared to somebody else who does not. So there are more people that could be like you that lives that kind of business you're in, and you have a fighting chance to basically raise capital from that like-minded individual. So that's in short what equity crowdfunding basically is. So of course, in terms of making this successful, we need a healthy ecosystem of amazing deals and also amazing investors. And investors could be from the sophisticated level, the angels, and the retail. So this series that we're basically doing is kind of trying to promote more people to become angel investors, meet angel investors like you to understand how did they basically get started and how did they basically navigate the scene when they do due diligence on particular deals. On our side, back to this particular slide, what we try and do is de-risk the particular investment as much as possible. Of course, there's no way you could completely de-risk it, but we at Leet try to highly scrutinize the deals when we basically put it on a platform. We basically have our own kind of ECF accelerator that we just basically launched, and we get companies to basically go through this journey with us to figure out, what is that offer that they provide to their customers, and beyond that, what is the value they provide to the customers to choose that offerings from them. What is that particular business model? Is it highly scalable? Are they basically leveraging on new core technologies they have today to help them with that growth that the funding is basically coming in for? What is that valuation? Does that sound like it's fair valuation? What are assumptions they put towards their financial models to talk about that valuations in place? And how much do they truly need? And does that make sense on what that ask and the use of the funds basically are? So we actively mentor and work with the companies that will be listed on our platform so that we do that basic checks for you. But of course, we advise every person that's going to invest into a company to do the same and look at the materials that we basically supply to you and understand the companies you're going to put money into and not just jump into something because of FOMO. I think that's something that is very important for you as you embark on this angel investment journey. So we have a couple of interesting deals that's on the platform. Coming soon is Green Factory. It's a very long-running family business that focuses on furniture development, furniture manufacturing. And now the families, the kids have taken over the family business and they've made it more into a sustainable factory. We're talking about 0% waste is what they're trying to achieve. And they've already got it down to 5%. It's quite amazing. People fly into the country just to visit this factory in terms of how they've basically got that process down to 5%. Amazing founder. He's become an advocate for sustainability and green. He's known as the Green Carpenter. You can find lots of podcasts and sessions on him online. And he's fundraising his particular first round itself on our platform. Green Lagoon is an interesting business too, also in the sustainability space. This is already live and running. It's going to be on for another month on our platform. And what they basically do is create biomass power plants. Basically, the fluent that comes from the palm oil mills basically gets converted to methane and eventually becomes energy from their particular turbines. And they produce that and pump it back into the grid. So each particular power plant they run has a nice 21-year concession with Tenaga National. They've been running efficiently and profitably for the last 5 years, and they're on to basically do the IPO within 18 to 24 months from now. This is basically definitely an interesting space for you to invest in if you're looking for something a little bit more stable with growth, possibly even dividends. I think they're looking at a coupon rate of 4%. You might want to evaluate that particular deal on our platform. All right. So before we jump into the content, just want to do a quick poll to understand who's in the room with us. Two polls, basically. The first question is, have you had any experience investing in the private equity market? That means on an ECF with us or anywhere else, or just trying to be an angel investor and you wrote a check into a safe round or into any particular startup before? And the other question is, have you ever been or registered with any specific angel networks locally? So can we run that poll? I'll just launch that. So you'll be seeing this particular poll on your screens right now. We'll just pause for maybe a few minutes to hear that. So far, a lot that has never invested before. We're getting a couple that has. Most people don't go into angel networks. That's interesting. Okay. All right, I think we've got most of you replying that already. So predominantly, it's about 70% of you have not invested in anything on the private equity market at all. 31%, which is just a few that has done it before. And most do not belong to any particular angel network itself. All right, good to know that. Thank you very much for participating in that poll. I'll just close that. Okay. So before again we start content, just want to brief you about Leet Capital in terms of if you've never invested before. I'm guessing 70% of you may not even have an account with us. Just want to quickly walk you through the process of what it entails to invest into a company on an ECF platform and how simple it is. So the steps basically to register as an angel investor or any particular investor on our platform is, first step, just go to leet.capital. That's the website. It's a brand new kind of domain name. So there's no .com, it's just leet.capital. Select sign in if you've got an account. If you don't have an account, of course, you click register and you provide us your details. So when you register, there are two kinds of modes you could register on, whether you want to raise money, and that's what we call an issuer. But in your case, if you're an investor, you say you want to invest. And when you invest, you will give us your typical registration details like your phone number, email, and a password to the site. And then there'll be specific things that we have to do from being a regulated platform. We call that KYC, where we have to make sure that you are who you say you are. And that basically means giving us details, your national identification cards, and also pictures of it back and front. And this is where we will actually on the back check to make sure the names and the ICs match what we see in that particular picture of the IC back and front. And some of the automation is basically going to check this for us. So there will be a quite delay for you to invest because we go through this process and it has to be vetted by us before we allow you to make your first investments. Also, as part of you registering, you need to kind of qualify yourself in terms of which bucket do you belong to when you say you're an investor. Everyone can be a retail investor, and what that basically means is you have a soft cap of 5,000 ringgit per deal. But if you want to go beyond that, it gives you a warning statement just so you're aware that as a retail, you shouldn't be exposed too much into a deal, but you can basically do more than 5,000 ringgit. There is a cap though for retail of 50,000 ringgit, and it's entirely for a year on a particular platform like us. So we do have a dashboard where you can see how much you've been exposed to. And when it hits that hard limit, we basically stop you for that particular year. Now, in terms of the other categories of being an angel and a sophisticated investor, that's defined by the guidelines from Securities Commission of what it means to be an angel, where we talk about no less than an annual income of 180,000 ringgit. And for sophisticated, it's basically personal assets exceeding 3 million. So to be in those categories, what we do ask for is proof. So you either send us, if you want to, a bank statement. It could be your pay slip, which what most people would basically use, or it could be a statement of your current holdings within Bursa to show what your net assets basically are. So you could choose what you basically need to disclose for you to go into a certain kind of bucket. Once that's done, your account's created, you get access to a dashboard to show you based on your retail, how much can you invest and how much you've invested. And all the statements and updates of a particular portfolio will all be within this website. So you can keep track of everything just by going to leet.capital each time. Eventually, if you're trying to even sell your shares in the future, we have a secondary market basically coming up soon. That will also be tracked within the same platform. So once you basically have it registered, let me just walk you through how simple it is to even invest into something. Same thing, go to leet.capital. In this case, you would sign in and then click invest now. It will give you an access to a set of deals that are basically running already on our platform. Let's say for this one, Green Lagoon, you will click on more details to get into the campaign page. And this is where you're going to get all the information about the campaign, being the one pager, the pitch deck, the term sheet, the agreements, the subscription agreement, whatever that they basically are disclosing, even in terms of their audits, will all be basically listed here at the bottom. And if you are okay with this deal, you click invest now. So just a quick highlight in terms of what these numbers mean. So there's a minimum and a maximum raise for each particular campaign. A company would only be able to receive the funds that basically you transfer to them if they hit the minimum. If they do not hit the minimum, then that money will be returned to everyone. Exactly what you put in is what you get back. There's no transaction fees that you basically incur. Monies that basically get transferred while waiting for this campaign to be closed is held in a trust account with us. So therefore, it doesn't go into that issuer's company bank account until we make sure that the campaign closes. And subsequently, there's also a what we call a grace period, right? That cool down period for 6 days. And this is when you can just have that moment of saying, do I really want to do this? If you want to back out right now, that 6 days is the moment you can back out, take your capital, no questions asked. And then we basically close the campaign and the funds get into the issuer itself. In terms of how the company is structured at the back, we use a nominee structure to hold your investments so that their cap table is pretty clean. And we don't see 300 people within their SSM registration itself. All that basically gets held in that SSM cap table would be Leet nominee surrender high. And we have a back-to-back agreement with all the investors that we're holding it on your particular behalf. So once you're sure you want to invest in that, you click invest now. You would basically specify how many lots you want. You acknowledge that. You click confirm. You will be given a unique reference ID. And this is the reference ID that you'll quote when you basically make that transfer via a bank transfer, an online transfer, whatever means you basically need to use. Don't worry about this number. If you forget what this reference number is, a copy will be sent to you via email. It will also be in your dashboard, so you can track back what that unique reference ID was, so we can make sure that we kind of do the reconciliation on our particular backend itself. Once that's done and you basically have transferred that, all your particular investments would be listed on your particular dashboard to see what you've invested before. If you had any exits in the past, it will be under the My Exit section to basically see how much you've been making in the past itself. And that's it. That's how you could easily invest into a platform like ours in terms of ECF and Leet Capital itself. So enough chit chat on the basics of ECF and how you get started on our platform. I think we've got most of our participants in this room already. Let's start the session on what you came here for, to have a little insights in terms of how someone angel invests. And that today is Mr. Phey Teckmo. Mr. Teckmo, are you there?
Yep, I'm here. Thank you. Can you hear me?
Yeah, I can hear you. It's a bit faint, a bit soft. Maybe you could just speak up a little bit more.
All right, sure.
All right, I'm just going to stop sharing so we can see everybody full screen. Maybe you could just spotlight the video too, so we can just concentrate on us. Welcome.
Yeah, it would be wonderful if everyone turn on the video if you can, so I can speak to people rather than have an empty screen. Thank you so much.
That'll be great if everybody could turn on their videos and also participate. So in the chat screen, you can type in your messages, you can type in your questions, but you can also later on turn on your microphones and ask the questions yourselves. That'll be great. So first and foremost, maybe tell us your background on who you are and what you do.
Yeah, I used to be what they call a corporate slave. I used to work day and night for a multinational company. I was running in the Asia business in multinational, and I travel like crazy. So I stopped doing that and mentor startups for free, and became what we call an accidental angel.
Hmm.
And now I'm quite an active partner at Angel Central.
Okay, very nice. And how did you get involved with the whole Angel Central and angel investments, right? Tell us what arose to the occasion and made you want to start investing into companies.
Yeah, so it actually started when I mentor startups, and sooner or later the startups will need to fundraise. Singapore is not a big place, so we introduced them to my friends. And the first question they will always ask me is, "Are you investing? Not? Why would you introduce us to the company if you are not investing in?" So then I need to put my money where my mouth is. That's where I first started, and now forward, I've done a number of deals already. Angel Central, actually, I was on the same cap table as my partners, and we realized actually the angel scene in Singapore was not active. So we created Angel Central to build a community of angel investors in Singapore and Southeast Asia.
Yeah, I guess that's a good thing, right? People always say if you want money, don't ask for money, ask for advice. Ask for advice and then the money comes. If people are advising you and they love what you're doing, then it's natural progression for them. If they love what you're doing, then they should be putting money where their mouth is, isn't it? If not, why would you just actively mentor someone and believe in a product and not put money in the particular product? So that's quite interesting. Do you remember what was the first thing you ever invested into?
Actually, the first three companies I invested in were Singapore SMU Management University companies. We came through the incubator there.
Wow, that's like really early stage, right?
Yeah, so I mentored them and I invested in them. So yeah, so there's the first three companies which I invested in.
And how did they do?
So one of them have an exit, so a small exit. The other one is doing very, very well. I had maybe a 20 times uplift on my investment. And the other company had get impacted through COVID. Previously, it had 5x up for me. And then COVID is very difficult to fundraise because that space is directly impacted through COVID. So the company is still running relatively well. So we cut off all our costs and continue to focus and make sure that our cash will be very strong. So they were profit positive last year, so I'm very happy about that.
Yeah, I love how when you talk about your portfolios, you actually use the word "our," right? Like you're also part of a team, which is very important. So I think that's one of the powers that angels basically do, right? When you come in, you're the extended arm of that biz dev section of a startup, of a company, to leverage you and your networks. And that's one of the beauties of being an angel, helping them expand. And if you are not an angel on this call and you are a startup thinking of getting angels in, I think that's one of the strong points, getting angels on board. It's additional manpower that gives you money and not takes money away from you. Do you agree?
Yeah, it's a bit of course, when you meet the startups, you mentor them, you help them. That's part of the journey, right? So you help as much as you can. So before I put in my money, I'm very skeptical on every damn thing. The moment I put in the money, I'm actually a cheerleader, right? I've got my money is in the money already. There's nothing I can do. So all I can do is help as much as I can. Yeah, that's part of the journey. Right? So actually, as an angel investor, uh, we 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 enjoy the entrepreneur journey without the pain of an entrepreneur. We don't need to deal with the difficult employees, difficult customers, challenging suppliers, right? We enjoy all of that, but we don't need to execute. But yeah, we can as much as we.
So, being like, how do you know if this is the company that you should invest into? How do you know if this is a good company or a bad company? Yeah.
Okay, so I think that there are two things problem you're trying to solve? How does your solution solve the problem? What's the economics for the customer to have that problem solved? Right. So I think the first question I would ask, right? Then the solution should be fully differentiated versus any other company in the region or in the country. And over time, it needs to be defensible, because the real challenge is a company. If you're successful, you will have 1,000 copycats who come after you. So you need to think about how are you defensible over time, and how are you sustainable, right? The third thing I would look for is the market size should be large enough, right? And so that the solution can be scalable, right? I think that's the first thing I would think about the idea. The second thing that I look for is the founder's skill set. The founder's skill set should be complementary. So for you to be successful company, you need multiple skills to be successful. So we want the founders to have different skills to solve different parts of the problem. Yeah, and normally I look for founders with what I call the X factor, which is learning agility. Because a good founder go through a huge journey, and they come out after 5-7 years, they are a very different animal. So what enables a founder to grow their skills, their capability, their insight to be a successful founder, right? So for me, it's a bit of a pattern recognition to find this type of founders. Right? It's not different than in a corporate when you identify a good talent and how you develop the talent over time.
Yeah. So then, do you need to really be in that realm of the problem so you understand it, or as long as the founder or company can articulate the problem that you have no idea about, it's not even your forte, you'd be comfortable to invest in a sector that you don't understand, or you must understand the sector to begin with?
Yeah, so it is the other thing that I just talked about, which is individual for everybody. For you to invest in this space, you need to have some kind of investment thesis of what you're investing in. So some people will be comfortable to invest in their space, which they are comfortable in, their experience. They know enough suppliers, customers, they know the problems inside there. So I've lived my life in technology, computers, telecoms, right? So, but I invest more than that. So that's the other investment thesis that you have, right? So you need to figure out what type of companies you want to invest in. Yeah, so I do invest in spaces which I'm not familiar with. Okay. But it's part of my learning because I'm a forever learner.
So do you then, sorry, continue.
Go ahead.
Do you then kind of adjust the quantum of how much you invest based on that thesis then? Like if it's about telco and technology, then you're comfortable putting more. If it's something you're not so sure about, but it checks on the problem, it checks on the product fit, the team looks great, and you don't expose yourself too much, or it doesn't get dependent on that at all?
Okay, let me answer that question later. Let me answer your first question, which is what kind of companies you invest in, right? So actually, I like to invest in spaces which I'm not familiar with. Because for me, it's learning. So I've never done hotels, I've never done healthcare, I've never done finance. But when I look at the problem, I will look myself as a normal person, understand what the problem is, and then talk to the people in this space. So I can then connect with my network of people with different spaces and understand what the real problem is and figure out whether the solution solve that, right? And part of my due diligence, I will talk to customers or suppliers or people in this space to learn. Right. Yeah. So I don't need to be in that space to be able to invest in. Okay. Coming back to your question on your ticket size, right? So I would recommend any angel investor to have a same ticket size no matter what space you invest in. The reason is you actually don't know why the company would likely to fail or why the company would be likely to be successful. Because it's not just the idea, it's execution, it's the situational kind of environment, right? So for example, the co-living company that I invested in who expected COVID to come in, right? Right. Even though we have a very good strength for capital efficiency, all the other things, and very good customer kind of approach and all of that. But so you actually don't know. So when you have so if you don't know which company are likely to fail and successful, it's easier for you to have the same ticket size. So when any company is successful, then the matrices of how you make money make sense.
Makes sense. That makes sense.
Right. So let me just give some math for everybody, right? So the ratio around the world is 1 out of 10 startups will be successful. 2 or 3 of them would be above water but doesn't return the fund, and maybe 5 to 7 would die. That's the ratio around the world. So depending on your investment thesis, you can do better than 1 out of 10. But assuming I'm not smart than anybody else in the world, I'm 1 out of 10 successful, right? So if my company have got a 10 times return, that means 1 time on my fund. For me to get 2 times on my fund or 3 times on my fund, every company needs to have a 20 to 30 times return for me, right? So if you have different ticket size, the worst thing you want is the big ticket size fail and the small ticket size is successful. And then even though you get 20 times, it doesn't give you 2 times because your ticket size changes. So when you understand the math of investment in this space, then you actually realize that the ticket size discipline becomes very important.
Right. And it's also about building that portfolio, right? It needs to be a portfolio approach to kind of hedge it across. So on your side, how do you plan that? Do you do research in terms of knowing what are the areas you want to get into, or you just look at the deals as they come and evaluate it one by one? So are you actively looking, or are you just passively receiving?
So I'm not actively looking, even though I do look at companies which are successful in America and China, and then figure out that does the idea work in Southeast Asia. But I actually whatever deal flow comes, I will look at it and I have a sense.
Okay.
I don't go out and find a specific idea.
Okay, all right. So I mean, when you do stuff like that, I'm sure you're getting a lot of pitch decks. So you did mention what you look for. I guess it will translate to the pitch deck. You look for the problem slide, the solution slide. There's the key things that you want in the slide. But you heard so many pitches, and what's your frustrations when you hear a pitch? What do you think people could do better in when they do a pitch towards an angel to try and articulate why you should invest in them? What is it that comes across well most of the times that makes you excited, and why don't you get excited about some pitches? Was there a key stereotype that you see?
I wouldn't say there's a stereotype, right? So I mean, actually, the biggest problem I would have is people don't fully explain the problem you're trying to solve, right? And sometimes actually it's a solution finding a problem.
Yeah, exactly. So when that's the case, of course, then you go like, oh, it's not something you'd be keen on, right?
I would then dig further to say actually what problem you're trying to solve. Okay. And sometimes the person cannot articulate very well. But if you can discover that the problem is very, very big and the solution is elegant and scalable, then my question is, why is the founder unable to articulate? Can you do any development on the founder? Will the founder be able to grow quickly? Right, because if they cannot communicate with me, he will not be able to communicate to other investors. And the startup to be successful, you need to fundraise multiple times, right? So if you cannot communicate, it's always a problem. A founder which cannot fundraise is always a problem.
Okay, that brings up red flags. We'll talk about red flags later, but still more on the process of evaluating a team. So I guess that you did mention something about due diligence just now. You would even actually go down to the level of saying, I want to speak to your customers. I want to make sure that they're there. And any specific other things you do from your duty perspective to be sure. And does the duty also depend? You said you write all the same check size, right? So everyone gets the same level of duty then?
No, it depends on how comfortable I am with the space, how comfortable I am with the problem solution.
Hmm.
The more difficult thing which I can understand, the more work I need to do.
But duty just say in terms of their finances, right? They come up with some projections, they give you some kind of Excel spreadsheets. How do you scrutinize those things?
Okay, so the I would definitely look at the projections and figure out whether the growth is based on what assumptions they have in the growth, right? Or is it just a mathematical number, or there's no basis for their assumptions, right? Then I look at their expenses. Where do they spend their expenses? How do they look at being flexible over their expenses, right? Because you need to make sure you've got burn rate based on your cash flow and your balance in your bank account. So I do look at that. Actually, I look at the unit economics also very strongly, to understand if you are successful, what is the potential outcome, and what is your journey from getting from the current kind of gross margin to the expected gross margin.
Nice. Okay. Yeah. So I guess the earlier startup that's trying to raise money, a lot of it are very much assumptions, but the later stage ones has got some historicals to kind of prove that trajectory. So then it's a bit more easier to perceive that their growth is real based on some form of historical data before that.
Yeah. So some of the pure idea, very, very pre-money with the 3 startups which I invested in at SMU. Actually, the projections were not so meaningful. Right? Yeah.
Okay. So red flags. What are your typical things that you look for red flags? So in case like projections could be one where they're pulling numbers from the sky. Any specific red flags that you have seen in the past that could be kind of passed down to our future angels that would be listening on these calls to kind of have as a checklist, check for this, check for that, check for that?
Actually, I think the most common red flag that I find is founders. Founders. Number one, complementary skills. Why are they doing this?
So the sense of why, the purpose, very important.
Correct. Because it's a very long journey, and it is a very difficult journey. So the perseverance, the desire to leave a dent in their life, or their life in their society, become important. The complementary skills, the value system between the founders, because the founders can break up if their value system is very different. Or most importantly, the founders are not full-time.
Oh boy, yeah.
Yeah. So the founder says, I got a team of 3 people, only I'm full-time, the other are not full-time. I mean, that is a red flag for me. Right. Okay. So I would say, okay, if I still like the idea, I still like the working founder, and I still like the other founders which are not full-time, I would invest in on the premise that the moment my money hit you, you need to be full-time.
Okay. What about those people who say, look, it's so hard to find technology people, and they resort to outsourcing development, or they have a developer firm that has an equity ownership in this, building it for them? What's your thoughts on those?
I don't like this. I don't actually this come from experience, okay? Because some of my companies which I invested in, they don't have a very strong tech team, so they outsource. Over time is a problem, because your response for your customers is normally quite slow, and your costs will go up. And sooner or later, when you are successful, you need to find your own team. The own team will rewrite every damn thing. So it's a very expensive journey, exercise, and of course, your customers need to go through the same journey as well when you change your tech again. Right.
Very true. All right, good. So we have Mr. Teck more till 11:30. He's got another appointment after this, so we won't stretch for time. If you have any pressing questions based on what we discussed so far, put it in the chat. I will basically try and address your questions. If not, I will keep going with my set of questions, right? So valuations, what's your thoughts on that in terms of what you see in the market? Because you invest actively in Singapore, you've seen some deals in Malaysia. Tell us a little bit of what you've been seeing.
So there is, I think the valuation changes from country to country. And especially when you're solving a problem in a country, right? So the affordability of the unit economics of that problem are very different. So there's definitely a different valuation in every country.
Typical angel rounds you're seeing in Singapore coming to you right now, was there a threshold of what the typical valuations are in Singapore for angels to come in?
Yeah, I mean, when I first came into this space about 7 years ago, I think maybe 2-3 million valuation is reasonable. Now I can see
Right?
5 plus minus valuation as a normal valuation. So it's more money chasing after very good startups, right?
So do you think that will be dollar to dollar comparison? And so if the ideal is $2 to $3 in Singapore, over here it will be angels coming in at 2 to 3 million ringgit, or you look at the conversion of saying it gets to 8 to 10 million ringgit?
My sense is valuation does change significantly. I would think that this by the end of this year, the valuation would come down. Mainly because the comparables of the listed companies, the public companies, would have come down. The cost of capital have come down, has gone up significantly, and I would think the valuation would start to change, right? So it's all supply and demand kind of valuation. So previously I would always have a kind of acceptable valuation so that my money will get a specific percentage of a company. But now I realize if I insist on that, I will pass on a lot of very good deals. So
what's a good equity amount you look for as an angel investor? How much is a good amount to keep from an early investments that it's worth your time?
No, it depends on your own ticket size.
Yeah, but is there a number you want? So you adjust the ticket size, or you adjust for companies at a certain valuation to get you that amount of equity you're looking at? 2-5%.
Okay. So you still start off with what is your financial outcome. If you want to have the same financial outcome, you should always have the same ticket size. So I just give you a rule of thumb. So this space is actually quite high risk. It's very, very high risk, right? If 1 out of 10 is successful, it is probably the most most risky asset class you can invest in, right? So you should never spend more than 10% of your investable amount in this space.
Okay.
So for example, if your investable amount is 1 million, you should never spend more than 100K. And you want to build a portfolio of 10 companies, then your ticket size is 10K in every company, right? And then let's figure out that 10K gets you how many percent of the company, right? So previously I used to use this kind of method to calculate what kind of percentage I get in a company.
Yeah.
But now actually it doesn't make sense for me already because the valuation have moved a lot. And then if I keep on those kind of percentage, I will never get to invest in a company, right? So, but valuation does come up and down. So if the valuation come down, I get more.
Yep.
So more importantly is when you invest in what valuation, what your expected outcome valuation, is it reasonable for the company? So give you an example. If you invest in a company at 5 million valuation, assuming don't count dilution. Right? Of course, you need to count dilution, but that's for simple math. If you have a 20 times outcome, the company needs to have 100 million valuation. So you need to have a kind of imagination, right? Your mind, your imagination, whether this company are likely to grow to 100 million valuation. 100 million valuation would be how much revenue? Right.
Yep. You work backwards that way. Yeah.
Yeah. And then if you don't think the company can get 100 million valuation, then can you accept 5 million? If you think this company are likely to get to 5 million, 50 million valuation, but not 100. Example, just you need to imagine, right? So then I will not accept anything more than 2.5, isn't it? Because for me to get 20 times return. So it's a bit of simple math to evaluate, isn't it?
Yeah, I guess that's it. When you're building a portfolio to know with that kind of capital you have, how much can you do per deal? Does it make sense to go into early deals or later stage deals? They got to start building that math model in their head, and or maybe even a spreadsheet to understand what like for ECF, when you get into equity crowdfunding, on our site especially, you're going to see more later stage companies. So your particular 10,000, 50,000 might get you a small fraction, but they're already at the verge at they're growing at a significant amount. So on paper, that's still going to be worth more down the line. But it's very risky to go down to a startup level that maybe won't be crowdfunding yet, but just doing angel placements with high risk, high gain, and to look at that, right? So I guess they all need to have their investment thesis going into this to know what they want to be exposed to and how much can they be exposed to.
Yeah, so if you think about if you're investing in a company which is revenue generating and later stage, right? So higher valuation. So you need to have a sense of what's your failure rate. If your failure rate move from 1 to 10 is 1 to 5, then you don't need 20 times return or 30 times return, right? So it depends on your own investment thesis, right?
Okay. So when it comes to this valuation, so I know there's a question, I'm going to hit to that question soon. When it comes to this valuation, sometimes they talk about multiples. Do you have a certain multiple that you think it's fair, or how do you decide when certain people come to you with valuation, especially pre-revenue? They're just pulling numbers from somewhere. And what is something that you're safe with in terms of them saying, I'm worth 3 million, but I've got nothing right now? How do you agree on something like that? Comparables, what do you use?
No, I mean, actually, there is a math that you can just follow. So if you're investing in, for example, e-commerce company, right? So you look at the listed e-commerce companies around the world, Amazon, Alibaba, and you say, what's the multiple of market cap versus revenue, right? And then they are scaled. So you need to give a discount, right? And then with the risk as an early company. So you have this kind of multiple, right? That's why I would tell you if the public market comes down, the multiples will come down as well. So every space is very different. So for example, if you're a restaurant company, you can look at all the multiples in all the restaurants, right, around the world. Hai Di Lao, Starbucks, McDonald's. That's the multiple they have already. You cannot be higher than that, isn't it?
Yeah, there's definitely the ceiling that you go through. Okay. All right, let's take some of the questions from the chat. Jasdeep's asking, have you invested in founders who were intelligent, dedicated, and competent, but still the startup has failed?
Yeah, absolutely. You actually never know, right?
Yeah, because of the environment, right? That's out of your control. Like COVID right now is something that you didn't see and it's out of your control then.
Yeah, absolutely. So it's part of this journey, right? As an angel investors, right? You need to figure out it's not just money. So for me, it's the engagement for the founders. For me to be able to activate my network to help the founders be successful. Right. Yeah.
Right. There's another question here from Wei Feng. How do you make decisions when a young millennial founder approaches you with a great idea, but limited experience and no funding to even establish a company? Would you entertain someone that just barely an idea and saying, give me the money and then I can start, basically?
No, I mean, he need to be able to figure out how he can build a solution as well, right? So if you follow all the idea of a minimal viable product, actually you don't need a lot of money to create the solution, right? So you need to just validate. Actually, your solution can solve the problem that you.
Yeah, because the question is, if someone's going to invest in a team, that means the team can still figure out how, even though they don't have funding, how can a team figure out what resources they have, which is people, to still put an idea together, right? Then that's what you have to basically show. So if there's some scrappy product and MVP to prove the problem fit is there, then I guess an angel would still be keen to see how they can help you with funding. But if you just say that I just have an idea and I'm not going to do anything till I get money to prove it, I don't think so anyone's going to give you any cash, right?
I would recommend people to read this book on Zappo.
Oh, is
The
that
idea
possible?
of Zappo, right? The guy actually validated the problem solution. Actually, initially, at that time, he wasn't sure whether any ladies would buy shoes on the website
Yeah,
without testing the shoes,
correct.
right? So all he did was he went to a store, take pictures, and then post it on the website. And anybody buy, he would buy from the shoe shop and then sell. And then he had some traction. Then he validated that the problem can be solved.
Yeah.
Right. So it doesn't take a lot of money. So I would recommend this gentleman to go and read that book. This is a very good example of a very simple MVP. You don't need
Yeah.
a lot of money.
Yeah, Zappos, amazing company, amazing customer service, passing of the founder recently. But yeah, read that book on Tony Share, how he started up Zappos itself. Another question from Michael Yap, I think it was based on the valuation stuff. Aside from the many other considerations to invest from the valuation perspective, do you use any threshold or multiple valuation to 3-year revenue profit projections for consideration? So is that something you're okay with, like projections of the future and the valuations based on future value rather than current?
No, no. So absolutely no, because so if you're using projections to figure out your DCF to go and calculate your current valuation, that's your future valuation. You will ask me to invest in this states now for your future valuation. Then how can I get an outcome when you hit the number?
Yeah, yeah.
Right. So
You
my valuation doesn't
get the
change.
same amount you paid for now, 4 years later, and then where's my growth, right? So what's the
Yeah,
point?
yeah, yeah. So that's potentially can be your valuation at the later stage. So
Mm,
my sense is, what is your valuation now when I'm investing in, and what's my potential outcome?
mm, mm, mm. Okay, very good, very good. So talking to the angels in terms of getting into this, what are some of the risks to basically kind of tell them on, like what are risks associated with angel investing and things they should be worried about when they do this, or things they should not worry about because it's part of the angel investment game to say.
No, I would say angel investing is not for everyone.
Yep.
You need to have a very strong appetite for patient capital,
Mm.
right? Because it takes a long time to have a financial outcome, right? So if you're looking at it from financial, you should never spend more than 10 or 15% of your capital or your investable amount in this space. So if you lose 10, all of them, 100%, you might lose some sleep, but won't kill you. But if you're successful, it's quite meaningful, right? If you get 3 or 4 times outcome of 10%, suddenly become at least a third of 40% of your total capital investment amount. Is quite meaningful. So I don't invest purely for financial. I invest in because I get the chance to learn different spaces and increase my knowledge and my experience. Also, I invest to be able to connect my network, right? Because I'm retired from my corporate work. So my network will be, we cannot drink coffee and play golf every time. When I connect with my network, it's then meaningful for me to have a conversation with my network as well, right? So that's why I do this, and I love the entrepreneurial journey without the pain.
That's nice. Outsource the pain to somebody else. Okay, Just Dave's got another question here. How do you choose an appropriate discount rate for small market cap risk?
So what do you mean by discount rate? So I didn't fully understand the question.
Yeah, just if you just want to turn on your mic and ask.
Yep. So I guess when you use multiples, as you mentioned, we use discount rates, right? You use a discount to the multiple. Sorry, yeah. So it's a discount to the multiple instead. So how do you choose what's an appropriate discount to that multiple to account for, let's say, small market cap risk or liquidity risk for private companies?
So if you were giving an example of e-commerce just now, you're comparing it to Alibaba and Amazon, and that's their market cap that it's known of there. So what would be a fair discount then towards an early stage startup coming in?
Maybe 30 to 40% discount. Well, just think about it. A pre-IPO company to an IPO company normally will have at least a 20% discount. Right. Right. And then just move it down for a kind of a earlier stage company, even pre-IPO.
Okay. Cool. Coming to about 7 more minutes before we end. One more question. So these days we started seeing a lot of startup founders who are early, especially, who's trying to raise capital. I mean, they still do not know how to basically put a price to it. So they've been trying to resort towards the notion of the Y Combinator safe document. What's your thoughts on that? Raising via safes. So equity in the future, but not now.
Okay, so a safe note is a very normal kind of practice now. I try to avoid safe as much as I can, but sometimes I can't, right? Because that's a normal way. If you ask me, a safe is not safe. Yeah, it is the most
unsafe
unsafe.
for who? The angel investor or the startup?
For the investor.
Okay, why so?
Because you're not debt, you're not equity. All you are is a warrant for you to invest. Okay. So the strength of a safe note is to enable you to invest in without defining the valuation. So you postpone the valuation to your next fundraise, right? So then whatever you invest in, depending on your kind of future valuation, and you maybe normally get a 20% around that valuation with a cap, right? Right. So it caps your valuation. So if the company is successful, I still get an outcome over time. But if the company is not successful, I still get a discount over whatever round. So it just postpone the future, the current valuation. Right? So it becomes a very easy instrument for people to use. Right? So you don't need to argue on the valuation.
Right. Yeah. I think we'll definitely do more sessions around safes. I think there's a lot of things to demystify. Angels don't understand that, and some issuers still don't understand that too.
So let me make a different comment. Actually, the valuation is all about doesn't or all, right? On whatever thing you think your valuation is. At the end of the day, is buyer seller, right? Whichever people are wanting to accept your valuation. So actually, if you ask me, I would recommend the founder just to focus on how much money do you need to raise and what can you use with this money to get a future outcome, right? When you work with experienced investors will give you a fair valuation. If they give you a very cheap valuation, you can always walk, right? But don't focus on the valuation. Focus on how much fundraising you actually need. And sooner or later, the money will come, the valuation will come after you anyway.
Yep, that's a good point. Let's just see a quick question about specific kind of company. Dylan's asking, how do you see B2B network marketplace replacing traditional business models in Southeast Asia? Do you like network marketplace startup models?
Yeah, actually, marketplaces are quite exciting because they can be very sustainable if they are successful, right? So marketplace, normally you need a group of suppliers and a group of customers. So more customers, more suppliers, more suppliers, more customers. Then over time become very, very defensible. right? So you need to figure out whether these startups are able to have scaled number of suppliers and customers, and what's your cost for acquisition of the customer and the supplier, right? Actually, if you ask me, I've never really invested in a marketplace because there are different spaces you can invest in. So some spaces are one winner take all, such as e-commerce. 1, 2 winner take all the others are very, very small. Still think about Grab and versus Uber, right? It's only one winner take all. After Uber says I lose, I sell to Grab, right? So your multiple can be very, very strong, but your ability for you to pick the company which is successful is actually quite difficult, right? So actually, my investment thesis, I like a space where multiple companies can be successful.
Good point. Good point. That's a safe way to do it. All right, cool. So 2 more minutes before you have to go. So let's just wrap it up. So we're speaking to Teck, who is a seasoned angel investor from Singapore, doing deals all over the region, including Malaysia. They're looking at deals over here. He's also co-founder of Angel Central. Parting words of wisdom, final advice to all the investors here today. If they only remember one thing, what should it be?
Don't chase a hot deal.
Ha! Good.
Right. If there's always a good deal, make sure that you like the deal. You feel that your investment makes sense. You can create value for the company and yourself. Don't chase a deal which is so hot that the valuation goes through the roof and everybody joins in and then you just join in. Never do FOMO. There's always a new deal. There's always a good deal coming.
Good. Fantastic parting words. Thank you so much for joining us today and sharing your journey on being an angel investor and the tricks of the trade that you basically use. I think that's beneficial to everyone on the call. Even some of the startups who are on the call who are listening in understands what it takes to have a conversation with an angel. Will just help them with that next journey that they basically face. Thank you so much for everyone for joining us today. If you are interested to do more angel investments, we will continue having this series of talks every month, meeting a different angel investor. There are deals that we basically have on our ECR platform. Welcome you to kind of partake in that. And also we're starting to maybe also put together a more kind of angel club within KL REMS. So that's something we want to basically do where it won't just be ECF deals. These are also deals that we're syndicating on the site that privately gets placed with our Leet Ventures team itself. So if you're interested to know more and invest into more early stage startups, which we think it's risky, therefore we don't put on ECF because we don't allow retail to participate in this, and you want to look at angel deals, just drop us an email and we'll basically love to introduce you to more interesting products that we're working on. All right, you may now disconnect. Thank you for being with us today.
Thank you. Thank you for having me the opportunity today.
We'll definitely catch up soon again.
Right. Bye.